Dilution, you can imagine you have a pie of pizza. The pizza is the cap table. You take the slice, your partner takes the slice, then your neighbors come in, and then there is no pizza. So you need to be careful with giving equity.
Okay, that was one of the best explanations of cap tables and dilution I've ever heard. Hey everyone, today we're speaking with Kristina Subbotina, the co-founder of Lawlace, an elite boutique law firm serving founders and VC funds. Kristina is amazing because she is, first and foremost, an amazing hustler and human being who happens to also be super talented in law. And she's going to be sharing her expertise around safes and particularly how founders should think about dilution early on. Kristina, why don't we start with the basics? What is a YC safe?
Yeah, thank you so much, Eric, for having me. And dear founders, I'm so excited to tell you a little bit about safes. So what SAFE is? It's a simple agreement for future equity. It's a document that was introduced by Y Combinator in 2013. And the reason why they did that, to minimize costs and the fees that you guys spent on legal fees. Because if you can imagine, if there was no standard document, it means that every lawyer will draft it from scratch, will have to negotiate it, and it's thousands and thousands of dollars. So in 2013, they introduced this form that is used as an open source document for you to fundraise. One thing that I want to make it clear, that it is not the equity that you sell to your investors, it's the right to purchase equity. Once you have an equity financing round or your company gets sold or goes public, that SAFE, simple agreement for future equity, gets converted into equity. But if there is no success with your startup, it goes nowhere. That's why some investors don't necessarily love SAFEs.
Well, we actually happen to be an investor, and a lot of early stage investors and angels are like us too that love safes. And for the reason that you cited. So, Kristina, I think your history lesson is really great. And I like to think of YC safes as almost like an IOU, right? You're not like issuing any equity yet, but it's almost like this promise that like we will issue this equity if we can get to that milestone where we do a priced equity raise, and then, we can figure out how to issue the shares with everyone equitably and reward those who came in early. But there's actually something that's a little bit confusing, I tend to find, Kristina, which is this concept of a post-money safe that's increasingly feeling like more common for founders to see. So if there's a new founder who's coming to the table to speak with you at Lawlace, how do you explain what a post-money safe is and why is it so popular?
Eric, that's a great point. So YC, after 5 years running with pre-money safe, they introduced post-money safe in 2018, if I'm not mistaken. And the reason why is because founders, they just started raising their whole rounds via safes, because they're like, okay, safe is a couple of $1,000s. If I do an equity round, it's going to cost me 20, 30 grand. Why don't I raise the whole $2 million, $3 million round via safes? What started happening is that founders would just issue these safes and they would not know how much of the company they sold. And once they eventually do a priced equity round, they just find out that they don't own much of their company. And that's the problem with pre-money safes. You don't necessarily know, it's not obvious how much of the company you are selling as a founder and how much of the company you are buying as a company, for two reasons. First is because in the definition of capitalization in the pre-money safes, all of the convertible notes and safes are not included. So it will depend on how much money the startup will raise prior to the first equity round. And so as an investor, you have no idea. And quite honestly, as a founder, you have no idea whether you're going to need $500K or $2 million. As you go, you might find out that you need to raise more money. And the second reason is the option pool increase in connection with the equity financing. So it is included in the pre-money safe. And as you know, Eric, option pool increase, it's heavily negotiated term in equity financings, right? As a founder, you want it lower. As a investor, you want it higher. That point gets negotiated much later. So while you're raising on pre-money safe, you have no idea how much of the company you are selling or buying. In 2018, YC, to rectify that unintended consequences of just uncontrollable issuance of pre-money safes, they introduced post-money safe. So the reason for that is to have a clarity on how much of the company you are selling as a founder. So for example, if you are raising 500K on $5 million post-money valuation, you know you just sold 10% of the company. And if you raise $1 million on $5 million post-money safe, you sold 20% of the company. And the reason for that, why you know those things, is because in the capitalization definition of post-money safe, and that's how you can do, by the way, you can download both pre-money safe, post-money safe, and you can go down to the capitalization definition. And in the post-money safe, you will see that all of the safes, they get included in the definition, and the option pool increase gets excluded. In that way, it doesn't matter how much of the money you raise via safes, what is the option pool increase in your equity round. You know exactly what percentage of the company you are buying and selling. And I'm happy to also kind of compare pre-money, post-money safes, because yeah, as you said, it's more popular because there's clarity, but there is also sometimes more dilution for founders to use post-money safe, because they get diluted once they raise money, and investors, safe and holders, they don't get diluted as was happening with pre-money safe. But nevertheless, post-money safe becomes that standard because clarity is really important. Right now, I have a client who's been doing business for a while and raised a bunch of money via safes, and especially pre-money safes. So once we did his equity round, he ended up owning only 35% of the company at the seed stage. Oh, yeah. So no sophisticated investor would want to be on board. So what we have to do right now is do recapitalization, and you don't want to be in that situation.
All right, Kristina. So I think the key term of what I heard in that really great example, but also in the explanation, is this notion of dilution. And you mentioned this founder that had 35% ownership at the end of it. But let's roll back a little bit. What is dilution? I think for even an early founder, that could be even a new concept for people.
So dilution, you can imagine you have a pie of pizza, right? You're starting with 100%, you have all of the slices, and then you take the slice, your partner takes the slice, then your neighbors come in, and then there is no pizza. So the pizza is the cap table. Initially, you and your co-founder, you own 100% of that. And then you start giving pieces to your first employees, consultants. Then investors come in and they tell you, hey, take our money and give us some slices of your pizza. And you need to make sure that these people bring not only the money, but some value to you, because this one pizza is all you have until the IPO. You grow the pizza by size, right? Making it more valuable. Like, initially this pizza is $10, but then it's like $1 billion pizza. It's kind of the same pizza. It just like in perception of all of the people, it becomes $1 billion pizza, but it's essentially the same pizza. So you need to be careful with giving equity.
Okay, that was one of the best explanations of cap tables and dilution I've ever heard. Kristina, let's dig into this a little bit more. With post-money safes and tying this notion with dilution, it's just far easier to calculate how much pizza you've given away. With pre-money, yes, it's certainly possible to do the calculations, but I'm telling you, founders, this is me as Eric, as your venture capitalist, talking to you directly. It is really easy to mess up these calculations when you have so many different kinds of pre-money valuations stacking on top of each other with capital that you raised prior to your Series A or whenever that post-money raise takes place. So Kristina's absolutely right. Post-money valuation, way easier way to manage your pizza. But let's dig in a little bit more about this notion of dilution. Look, you've seen so many of these deals, Kristina, and we're talking primarily to seed stage investors here at Uncapped Notes. What is the right amount, you think, to dilute yourself prior to getting to that priced raise? Let's call it a Series A.
That's a great question. And the amount of dilution you are comfortable with directly corresponds to the valuations of the company, because the valuation of the company, that's just imaginary thing that all people agree, but it's like paper money, right? But how do you define like how much of paper money do we pay for our pizza? So the right amount of dilution, I usually see between 10 to 20% per round. So seed, sometimes pre-seed and Series A, you dilute yourself. Once you're done with Series B, you can lose the majority. But in Series A, ideally, you still, as a founder and all of your team, common stockholders, you guys should own the majority of the company. That's the golden standard. And in Series B, you kind of lose it. But by that time, you lost more than half of your pizza, but the whole price of that pie is already like big enough that you don't care. You're like, if my slice is like worth $1 billion, like I don't care, that I give you the rest. And one thing that I wanted to point out with pre-money safes, because safe is not equities. Safe is not the slice of pizza. Safe is like the paper that I give you. It's like a ticket. You have a right to come to me at a later time, assuming I still have this pizza on my table, and you can get that slice. And with pre-money safe, you don't know how to cut it. You don't know how much. With post-money, I kind of cut it for you. We already know that, this is yours. With pre-money, God knows. And by the time all of those people with those tickets come back to me, once they cut their slices, I, as a founder who made this pizza, might end up with such a small slice that I don't even feel incentivized to grow this pizza anymore.
This is amazing. So probably one of the best explanations I've seen from anyone talking about how to rationalize safes, think about dilution, think about targets for dilution, and you've outlined a few traps here. Now, there's a lot of other things we can talk about when it comes to the nuances of safes. Maybe actually this is a good time to switch gears. Kristina, can you tell us about this firm that you're building and how did you get here?
Oh my God, Eric, that's the the universe. The universe brought me here. But happy to share a little bit about myself. This year in February, I left Cooley to become a venture investor. Cooley is incredible. It's synonymous with startups. And I think at Cooley, I learned that the simpler you can explain things, the more you can charge. Because in order to be able to make things simple, you have to really understand them. Yeah, you have to use plain language. Nobody wants to hear legalese. And only if you really, really know something, you can explain it to a person if you are 5 years old. So Cooley is incredible. I've represented startups there throughout their life cycle, from formation, financings, day-to-day business operations, and exits. Prior to Cooley, I also worked at 2 venture-backed startups. I was an associate general counsel. I was doing all of the corporate matters, helping them from Series C to Series B. So I've always been focusing on early stage startups and also VC funds investing in those startups. And me working in startups and then at law firm working with startups and VC funds, I kind of seen it all of the life cycles from different angles. And it gave me a 360 overview of what interests each participant in this startup ecosystem has. That way, I feel I'm prepared to launch my own venture, Lawlace. That's, as you mentioned in the beginning, is an elite boutique law firm that focuses on representing startups and venture funds throughout their life cycle. I feel that, especially for early stage startups, big law model is not the perfect fit because it's really hard for early stage startups to afford those billable hours more than 1,000 per hour. And that's where we come in. You don't want to end up in the hands of people who haven't worked with the top startups, with the top VC funds, but you also don't want to pay $1,000 per email, right? Because you rather spend that money on product, on going to conferences, on getting the customers. And that's why I think we have this unique proposition. We also incorporate an AI solution to expedite our work. So we don't necessarily charge per hour. We have some monthly packages. That's why my business model is to do the best job as fast as I can. I'm not incentivized to drag the matters for a long time. And that's the traditional big law model. You're not incentivized to bill less because by billing more, you make more money. And I also wanted to give a little bit of personal detail how I came into the US. I'm a hustler myself and I'm an immigrant. I came to the United States in 2014 from Russia. I studied law at University of Southern California, and then I worked for the federal judge at the US Court of Appeals for the Ninth Circuit. When I came to the US, I didn't really speak English that well. So I was learning law in parallel with English. When I was taking my New York bar exam, I actually didn't fully understand all of the words on the exam. And that makes me relate to founders so much. For founders, all of this legalese, it's a foreign language. For me, it was a foreign language, like it was literally foreign language to me. I had to learn all of those terms and understand them. It's a different legal system. And I feel like many founders, they're also immigrants. So they have to adapt to being in the US. They have to start something that hasn't been done before. And they also, on top of that, they have to learn something that I've been learning for many years. And honestly, I'm still learning. This process never ends. So I want to make life of founders easier, at least in this legal, arena, that they don't get bankrupt because of legal fees, but they also get things right. So legal doesn't kill their startups, which unfortunately I've seen how like improper things. And there are, I would say, like 10 top things that early stage startups should like do. You can mess up other things, but some things you just cannot mess up, like QSBS, 83B election, IP assignment, and stuff like that. It will not allow you to succeed and raise money from sophisticated investors. And as I was starting, in 2014, I had people who helped me. Now I want to give back and help founders to make their dreams come true.
Kristina, I got to say that I'm so inspired by your journey. And I'm also so delighted and honored that we get to serve founders together. We've known each other for over a year at this point. You're one of my favorite human beings I got to meet in our industry. And I'm so, so excited for this next venture, this AI-driven law firm design that you've created. I've never seen anything like this with Lawlace at lawlace.com. I hope that founders can check it out. And Kristina, what's the best way for founders to engage with you if they have questions about working with you?
Yeah, you can visit website of my law firm, lawlace.com. Also, I share absolutely for free legal tips for early stage startups and wellness tips for founders. So founders, not only law is important, but wellness on TikTok, Instagram, and YouTube. You can find me, Kristina Subbotina, and I have my website, www.kristinasubbotina.com. Me and my team, we provide a lot of content for founders in this funny way that sometimes you guys don't know what you don't know, but once you watch something, many of my clients, they just binge on my content and they're like, oh my God, I did this wrong, I did this wrong, I did that wrong. I think that might be helpful for you to start there, and then you can message me. I'm truly excited to help you on your journey. I really want you to win.
Awesome. Well, Kristina, thank you again for today's session. Uncapped Notes listeners and viewers out there, thank you for watching, and we'll see you at the next Uncapped Notes. All the best.